And I think we are good. Recording? Okay, good. Excellent.
Love it.
Thank you so much for being here and wonderful to see you. You look marvelous.
Thank you. Excited to be here.
And do we have
I,
Tony here as well, or is she just kind of
she's watching.
looking? She's
She's
watching.
watching.
Okay, excellent, excellent. Well, I was a little concerned about going live with video just because once you get on something like YouTube or Facebook or anything else, there's two things that happen. One, you really got to monitor it. You get all kinds of crazy things going on with people out there if it's anonymous, which I just kind of gave up on that completely. And then two, I'm up here on the mountains in Santa Barbara with basically a new network. We're on Starlink, and so we were on DSL for years, and so
Yeah.
we moved over to Starlink. We've been on that for a year or so, and just got all new routers and a bunch of new equipment here in the last few weeks. So I've been kind of going crazy, going, I sure hope this all worked when the time comes. And it looked like it's working great.
There you go.
So
Yeah.
thank you for being here. Thank you for making it. And God, you and I actually made contact a couple of years ago. I was looking at the text messages.
Yeah, I remember that was probably right when we first started. Much better now. Much better. I'm glad we're connecting now and not then.
Yeah. I mean, it would have been fine too, but the nice thing about Google Voice is it has all the Google abilities for doing, searching and that kind of stuff. I mean, you could just go back for years and put in one little word and things would come up. So
Yeah.
we made it. We finally are here, and I'm just excited to see you.
Yeah.
So,
should I share my screen?
if you want to move on, I've got a couple, beginning questions, maybe somewhere in there, and that's fine. You're doing good. You got the screen up there and it's sharing just perfectly. And I just want to know, so how did you get started in the note business?
Yeah, I don't talk about that a lot on this webinar, but as we don't have a ton of time, it can go forever. But I actually got started in it as a individual investor. I attended a lot of REIAs and networking events and stumbled really into mortgage notes. I'd been familiar with everyone was doing wholesaling or fix and flip or, some sort of long-term rentals. And in Santa Barbara, capital doesn't go that far. And I wanted to really be able to diversify and kind of try my hand at something and not have all my eggs in one basket. So mortgage notes came up at one of the REIAs and I started reading everything about it. And then I started actually investing myself before now in second position mortgage notes that had like ample equity coverage and built up a portfolio of seconds before I transitioned to firsts. And then I met my current business partner, Chris, and we launched this fund together. And I worked on a couple other funds with him as well.
Excellent. Wow, that sounds really good. And it looks like you're going to be heading to Los Angeles to the, I think Expo number 5 there with.
Are you going?
No, I've been to many of them in the past, and I'm just kind of refocusing after getting rid of about 20 properties in the Midwest. And during the pandemic, when all that stuff happened, they said, "Hey, everybody can live there for free." And I went, "No, I don't think so." So sold a lot. It sold basically all of them. Kept a couple of things here locally in town, and just kind of refocusing into vacant land. Still doing wholesaling of properties, nationwide, but focusing in the Las Vegas and Northern Nevada and California. Can do anything nationwide, but I'm trying to focus in a certain area. So that's what I'm up to. But you're going to be there with a lot of speakers, and there's going to be a lot of people. Have you done it before?
No, but I've done a lot of different. I'm actually going to be presenting this deck, actually, or some modification of it, because it needed to be educational, and I can pitch my product at the end. But I feel like this is a good. I think I'm going first, which is great. I love that.
Good. Yeah.
And I think this will be a good for the crowd that's there. I think this kind of presentation will flow really well because It's all about like evaluating sponsors. What are you looking for? Do you want income? Do you want growth? Just a lot of the questions that people don't know to ask when they're looking to start investing in real estate.
Yeah, excellent. Yeah, and it's kind of an easier way to ease your way into it without just tons of money too.
Yeah. So like the first part of the presentation I do talk about mortgage notes in the second half, but the first part is like really very directly like, what are you looking for in an investment? Are you looking to be active or passive? Because I think people get those confused. Even managing your own mortgage notes is not passive.
Right. So yeah. There's so much that people think is a lot of passive stuff. Yeah. And when you get into it, you go, there's a lot of work here.
Yeah, 100%. So yeah.
Well, excellent. Okay, I'll just let you run with it, and I'll save any other questions I've got toward the end, and we'll get this recorded. We'll eventually get it up there. It won't take very long at all to get it up on YouTube, and awesome. It'll also be right there on the Santa Barbara REIA website for people to click on, and they'll be able to get back to you anytime because your information's there, and we will continue doing business.
Love it. Okay. Well, thank you for having me today. I'm so excited to be here and talk about really passive income funds, how to evaluate deals when you're just getting started and thinking about investing in real estate. And then I'll touch a little bit on mortgage notes specifically. Let's see if it'll let me go to the next slide. I got to go over here.
Okay.
So we have our disclaimer. We are not, investment advisors. You need to do your own research. Past performance is not indicative of future success. To keep all the lawyers happy in the room. And so today I'm really just going to talk briefly about who 7E is, what is our backstory, and then really kind of walk you through this investor journey of like when people typically show up, as I used to a REIA or a networking event, are you looking to be passive versus active? What are the different opportunities available to you? And then how do you evaluate the sponsors behind the deals? So really quickly, I mean, my backstory, I shared it with you a little bit, Dan, earlier, is I actually started out in a W-2 job working tech sales and used my commission to fund mortgage notes. We'll talk about what that is. Essentially, I was purchasing mortgage notes on the secondary market, built up a portfolio of second position liens because I could get them for significantly less and kind of diversify my risk, mitigate my risk or spread it out. And then I made that transition into first liens. Now I met my business partner, Chris, right amidst that transition into investing into first liens. And we started managing funds together. We've done over 600 individual deals together. And what we realized was that not everyone has access to this type of investment. Most passive investments are really reserved for ultra high net worth or high net worth investors who have a minimum of 50 to 100K that they want to invest. Now, that's not an astronomical amount if you're accredited. However, it might be if it's your first alternative investment. So we actually went down this path of launching what's called a Reg A route, a Reg A fund. And I'll talk a little bit more about what that is. But it came from our passion as individual investors who saw a need to really apply and give everyone access to private offerings, to invest in funds and syndications without having to be accredited. So what we do at 7E, 7E is really our brand, and we're a real estate investment company that is focused on buying and selling mortgage notes that are secured by single family homes throughout the US. We purchase both performing and non-performing, and we like to say we fix and flip mortgage notes. We say fix and flip, and I have a whole slide on what that is, so bear with me, because it's a concept that everyone can resonate with. You know what it's like to fix and flip a home, or you've watched an HGTV show about that. So it's really what we do, but we apply that concept to mortgage notes. So our mission at 7E is really, with the foundation of the Reg A, to democratize investment opportunities while providing win-win solutions to borrowers. So we're making it available and accessible to both accredited and non-accredited investors with a low barrier to entry. So kind of backing up, when I was attending these kinds of webinars or in-person events, I didn't really know what I wanted to do. I just knew everyone I knew that was successful invested in real estate or owned their own business. So I was learning a lot. And you talk about, okay, I want to be passive. Passive income is, the buzzword. But I think what became clear to me is there's a very stark difference between what you think is passive and what is actually passive.
Yeah.
So when I started out, I thought, okay, if I get some rentals, that's passive income. And then I looked at my colleagues or friends that had done that, and I was like, actually, that's not very passive.
No.
You have to deal with tenants calling them, the roof is leaking, the toilet's not working. So that, really wasn't very passive to me. So, there's benefits to active investing. You have control, you have more flexibility, there's some tax benefits. The cons are it is more time consuming. There typically is a higher barrier to entry, and it costs more and you have more to lose. All your money is in typically one investment. Now, when I looked at passive investing, there were some pros and cons as well. You didn't really need, as a mom of 2 boys running a business, there was less time needed from me. I could diversify and put it into a few different funds. Typically, there was a lower barrier to entry. However, I wasn't in control. I had to trust whoever the sponsor or the person running the fund, and I didn't really have any say in the decisions. So kind of weighing both of these, I decided to go the passive route because at the time I was, working a W-2 job. So let's just say you're sitting here and you're like, I want to be passive. So we're going to go down the passive loop because that's what we do. Then you're thinking, okay, I think it's important to assess, like, what do I want? I think people just think passive income because that, again, is that buzzword. However, there's really 3 different buckets I'd say investments in the passive category fall into. You have your growth bucket, which is really typically higher risk, but you have a potential for higher returns. And it's something like a development project that you invest into that increases in value over time, and you want your capital to grow rather than the income immediately. Then you have your tax advantage funds, which you can think of like an oil and gas fund or a opportunity zone. And those are great for people who are trying to reduce their taxable income. They offer tax-free growth or withdrawals, and they're useful for really long-term financial planning and to offset capital gains. And then you have income, which is really focused on, I want regular monthly, quarterly, or annual income paid directly to me. And it's for people who really want that steady cash flow. They're looking to subsidize daycare for their kids, their car payment, their mortgage, college tuition. Typically with income funds, you're going to see less risk, but there isn't as much of a return profile there. So then you've decided, okay, I want income. You go into then the types of assets. Okay, so you say, I want an income fund. And then you kind of you can look and search income fund, real estate, income fund syndications, income fund private placements, income fund energy. And you'll see there's a ton of different, what they are called asset classes that you can invest in. And things to consider here are for you, like, what's your risk tolerance? What's the return profile you're looking for? What is the market doing right now? For example, probably stocks and bonds, right now it's ripping. You might want to go there. But, a few months ago, that might not have been the case. Market dynamics are a big influence, economic climate, interest rates. What are your goals? Are you looking for something that provides monthly income, quarterly income? And then what is that time frame? Is there a lockup period that you don't mind your money being locked up for? And then that kind of can help you weed out, like, okay, I want to invest in some sort of real estate fund. Now, what are my options here? Typically, there's 2 types of funds, and I'm going to start with Reg D because it's much more prevalent and most people know about it. Reg D is super easy to get started. You basically go to the SEC, you file a piece of paper, and you say, I'm going to raise funds from accredited investors. Thank you very much. And you're on your way. Now, there are some nuances here. So with the Reg D, there's no limit on how much you raise. You can raise only from accredited investors. There are no disclosure reporting requirements, and there's no qualification costs. So it's really easy for someone for a sponsor to go and say, I'm going to raise capital for this apartment complex. And thank you very much. Now, a Reg A, on the other hand, which is starting to grow in popularity, is under much more scrutiny from the SEC. Rather than going to the SEC and telling them, hey, I'm going to do this, you go and you basically ask them to qualify you to raise capital. And the reason is, with the Reg A offering, you can raise money from accredited and non-accredited investors. This is huge. It opens it up to anyone can invest. So it's kind of like crowdfunding on steroids. You can raise up to 75 million in a 12-month period. So you are limited there. And you do have to file an annual audit and offering with the SEC to get requalified every year. So it is, again, much more stringent on what you need to do, reporting requirements, and qualification costs. Typically, the timeline to get a Reg D up could be a day after you submit your PPM. Reg A takes anywhere from 6 to 12 months to get qualified. Wow. So yeah, and we're seeing a lot more Reg A in the industry. Kind of give you an example, in the last few years since we launched our Reg A, I used to attend conferences and speak about our offering, and I was one of 2 Reg A's in the room. I attended a conference 2 weeks ago. Everyone else was Reg D. I attended a conference 2 weeks ago, and there were about 3 or 4 of us that had Reg A's, with another, I'd say 5 to 10 who were saying, we have our Reg A coming out soon, because they're probably still undergoing that qualification process.
Okay. Would you say that's because there's just a lot more people you can work with, as opposed to limited people who have a whole lot of money, but there's not a lot of those people to work with?
Yeah, I think it just opens it up and you can market it. So we can publicly market on our website to anyone. We don't have to do any accreditation verification. They have to self-attest if they're accredited or not, but in the investment process. But other than that, it just makes it easier. There's a less of a barrier between, okay, I can't market. Well, I guess you can in a 506C, but a 506B, you can't market. So you're really kind of confined to family and friends or people that you have a relationship with in a Reg D. Whereas the Reg A, you're saying I can raise money from accredited and non-accredited and anyone on the internet because I can market this. So it just opens up the doors to more people having access.
Sounds like it would also give you a better opportunity to advertise the Reg D when you can't really do that because you're advertising through the other.
Correct. Yeah. So I spoke with someone today who was interested in our Reg A offering. And then when we got on the call, he actually was more in line with our Reg D firm or our Reg D terms. So I was able to talk to him about that because he had already told me he was accredited. And either way, it would have allowed us to work with him because he was accredited. And even if he wasn't, well, we have the Reg A. So it does. It opens up a lot of doors.
Okay. Yeah. Excellent.
So if anyone who doesn't know, accredited, you have to either hold a Series 7, 65, or 82 license with FINRA, which is essentially a financial management license. Or you have to have a net worth exceeding 1 million individually or combined with your spouse, or have earned income exceeding 200,000 during each of the last 2 calendar years, or 300,000 combined with a spouse. So it's one of those 3. And then non-accredited is really anyone with the acumen and experience to evaluate risks, but don't meet the requirements of an accredited investor from a financial standpoint.
Excellent.
Yeah. So you've gone through, you want an income fund, you want something in real estate. You're saying, okay, I'm not accredited, so I'm going to go Reg A. You can probably Google Reg A funds, real estate, and you'll probably get a list, maybe. I should probably do that. Maybe I could pull that up on screen next time.
Yeah.
But then you're going to want to say, okay, I've evaluated these 5 funds that are Reg A's, that are in real estate, and that sound interesting and fit my criteria. So then you're going to want to look at the sponsor or the person running the fund. Now, you're going to want to say, okay, who are they? Who is their team? Are they local? Are they outsourced? Have they done this before? Is their first rodeo? Do they have a track record? What has their track record been? And maybe even ask for a track record verification report. This is something that is super easy to obtain as a third party or as a sponsor. It's done by an independent third party, and they basically verify that all the past funds have hit their specific returns in the offering statements that they had? And then do they have any reviews or testimonials or previous investors or current investors that you can speak with? So you're kind of learning and doing your due diligence now on them and how they operate, because at the end of the day, by going in that passive route, you're giving up control. And you're giving up control to this person, this sponsor who's running the fund. So you want to make sure that you feel comfortable with this person managing your money. And then looking at their compliance, are they registered? Are they properly filing things with FINRA and with the SEC? Have you reviewed their offering documents? In the case of a Reg D, have you looked at their PPM or offering circular? In the case of a Reg A, did you read through it? Do you have any questions? Have you had your attorney review the documents and bring up any concerns they might have? Again, all these things are really to mitigate your risk at the end of the day. Which brings me to understanding exit strategy and risk. So getting on the phone with someone at the company, hopefully either someone on their team, someone local, what is the company's exit strategy on assets? How and when can you exit the investment? Is your money tied up for 1 year? Is it tied up for 4 years? If you have to redeem your money earlier, is there a penalty? And then you want to understand, okay, what's the worst case scenario here? Do you have any additional debt? If you were to have to file for bankruptcy, is there a lender that you have to pay before I get paid as an investor? And then asking them about the risks involved and how they mitigate risk, to hear their thought process and how they think through things. And then reviewing the fund's historical performance and the asset classes market resilience in general is really important. And then this is something I feel very passionate about, is that transparency and communication. How transparent is the sponsor? Can you talk to someone on the team? Do they communicate directly with investor inquiries, and do they respond in a timely manner? Are you able to speak to someone if you call? Are you getting transferred overseas? Do you always have to leave a message? Making sure that your expectations and your principles and interests align with theirs. So also from that perspective, your interests as far as what's in it for them? Are they taking a management fee? And it doesn't really matter how good the fund does, because they're getting a 1% management fee on your money. Or are they only in it to win if the investors win? So what's important to you? I think some red flags when you're vetting a sponsor are poor communication, lack of experience. So someone who got into this in the last pre-COVID, we saw a lot of this, or during COVID, we saw a lot of this. A lot of people rode the wave of low interest rates in the multifamily realm. And I'm not trying to pick on multifamily, but the multifamily realm of low interest rates, assuming they would be able to refinance, cash out, and pay off their investors. And now they are scrambling because interest rates skyrocketed. And those people didn't have, if you had looked at their track record prior to COVID, they might have done one deal. So it's really important to see what's their experience, not only in a thriving interest rate environment, but a high interest rate environment. Conflicts of interest. So are their interests aligned with yours? Do they win if you win? And, are there any other third parties that they're doing business with? They have affiliated transactions of any sort. And then I mentioned this on the last slide, high fees. What are you paying them from a fee perspective? Because that comes out of your return. So if they're saying you're going to get a 10% return, but after the acquisition fee, the disposition fee, management fee, account fee, you're I'm really only netting seven. Does that make sense? Is there another option that makes more sense for you? Which leads me into what we do. So mortgage note investing. It is really an alternative investment strategy secured by single family homes in our case, or physical real estate. Note investors are buying loans from lenders, banks, credit unions, hedge funds, or whole loan traders. And investors are purchasing mortgage notes typically at a discount, and I'll talk about why in a second. And they're assuming the position of the bank. They're not becoming a bank, but they're becoming the lender for as long as they hold the note. So as the note holder, the investor has purchased basically the rights to the borrower's future payments and the rights to repayment if they default on their note, meaning they can go through that foreclosure process because it's secured by the physical property. So I talked earlier about how we like to say we fix and flip mortgage notes. So here's at a high level what we do. We buy loans on single family homes at a discount to unpaid balance. These are discounted because banks, for a couple of reasons, banks are good at creating debt, horrible at managing it. Anyone who's watching this, you might realize that trying to get anyone at a bank who's a person that knows the right department for you to speak with is kind of like, it's if you've gotten that far, you're lucky.
It seems to be increasingly more difficult.
It does. So banks are bad at managing debt. They're great at creating it. Now, they sell because if they have some non-performing, meaning borrowers who aren't paying on their books, it inhibits their ability to create new debt, meaning they can't write a good loan because it's on their bad. They have all these bad loans on their books. So they are selling these at a discount. Yes, they're going to take a loss, but they can take what they sell it for and create new loans at 7-8%. The same reason that they'll sell good loans at 3% at a slightly less of a discount is because they're losing money on a loan at 3% when they can write one at 6 or 7%. So we're buying these loans on single family homes, and then we are going pretty much one of two tracks to flip it. So the fixed part is we're buying it at a discount. We're fixing it up here by either the top route here is negotiating a payment schedule with the borrower. So typically the people we work with don't just decide to wake up one day and stop paying their mortgage. I think that's one of the biggest things I learned when I got into it is that there's typically some sort of life event that happens, whether it's death, divorce, job loss, or a health issue that caused them to fall behind. And then when they go back to the bank, who's notoriously hard to get in touch with and very inflexible, the bank applies anything that they pay to their past due and arrears, late fees, all of that. So the borrower's never going to get caught up. We assume this loan and we say, okay, can you still make your monthly? And they say, yes. We negotiate a 6-month trial payment plan with them. To pay their monthly payment. At the end of 6 months, we will modify their loan. Now, it's important to note that we don't touch interest rate. We are simply modifying the arrears. We're either extending the term or they're making quarterly or monthly payments towards their past due balance. So all that time, we're negotiating payments with the borrower, but we're generating revenue from their payments. And then we're able to season the loan, meaning we're getting at least 12 to 18 months of consistent monthly payments, which takes it from a non-performing status to a performing status. And that allows us to then sell it as a performing loan for a profit. So there's that fix and flip.
Okay.
And the borrower might also, in a low interest rate environment, for example, during COVID, we saw tons of people refinancing and paying off their loan, or the borrower can sell their home and the loan gets paid off. Now, important to know, if we're looking at a loan that is a $200,000 loan and say we get it for $130,000 and it ends up the borrower ends up selling the home, we are still owed as the lender that $200,000. It doesn't matter what we bought it for. We're still getting paid the full amount on the note. So the discount, well, there we go. So I kind of explained that here, but hold on, let me go back here for a second. The second route is really taking ownership of the home, and that's about 10% of our portfolio, where the borrower decides for whatever reason they are not going to pay us, they are not going to work with us, they have no interest. We will go through the foreclosure route, and typically that property in times like today is sold at auction. We're paid off in full. In the rare instance that we do take it back, we will look to sell the home. So again, turn a profit that way.
Do you also take the loans directly from the bank if the bank has foreclosed on the property owners, or are you getting it strictly from the property owners?
No, we're getting it from pre-foreclosure, but they're in default.
Gotcha.
So like the average delinquency is about 2 years on our portfolio.
Okay. Yeah.
So just to kind of give you an example, if we have a property that's valued at $250,000 and the loan balance is $100,000, we're getting that for $50,000. So we're in it for our LTV, that loan to value is already significantly low. It's 40% LTV. But because of the discount, we like to talk about our investment to value. So we're in it for 20% investment to value, meaning that $250,000 property would have to drop below $50,000 for our investment not to be covered. So it's one of the really big upsides and things that I say when we look at mitigating risk that people find attractive about what we do.
Okay.
So like I mentioned, we are big fans of the Regulation A route, even though the SEC does take forever and hold you very accountable, because it opens it up to accredited and non-accredited investors. It's a 4-year term. We do have a death and disability clause, so people's beneficiaries can redeem if they were to pass or have a disability prior to that 4 years. The minimum investment is $5,000, and we do offer some bonus shares starting at $25,000. And we offer a preferred dividend anywhere from 8 to 10%. And it really, that increase or that variance is because of the bonus shares. So the bonus shares increase your total return. And to kind of show you what that looks like for people who, for example, invest $25,000, they get 100 bonus shares. So you're paid, and each share is worth $10. So you're paid 8% on $26,000. And at the end of the term, 4 years, you can actually redeem for $26,000, not 25. So you're accruing 8% on 26 throughout the 4 years, paid monthly. And then at the end of the term, you can actually redeem both your initial capital contribution and the bonus shares you were awarded. And you can see that's the kind of the percentage of bonus shares increases with the investment here.
Yeah, that makes it very easy for somebody to come in with $5,000, as opposed to dealing with a property.
Yeah. So kind of some highlights. We are open to qualified and non-qualified accounts on the Schwab platform. We do pay dividends monthly. It's a non-correlated asset class, which means it's not correlated to the whims of the stock market. Also, interest rates, we're pretty interest rate agnostic with what we do. We have really, we seek up to 4 times collateral coverage, meaning when I showed you that graph earlier of the $250 home and we paid $50,000 for the loan that was worth $100,000, you know, you're significantly covered by the collateral of the home. It is not a blind pool. I think this is really important because we're not raising money on an idea. We have a fund that is raising capital and deploying capital monthly. And it's not, we need to raise X amount to break ground on this development. And then hopefully A, B, C, D, E, F, G goes right and you get your money back. We, you know, like I mentioned, I've been doing this for just under a decade. We've done over 600 individual fix and flips. And our current portfolio has just under 60 assets, I believe. No fees. So all offering expenses are paid by us. We don't have acquisition, disposition, or management fees. We really are in alignment with the interests of investors because investors are paid first and we win after investors win on the upside. And then from a tax perspective, this is a little unique, and I am not a CPA, so please check with your CPA or tax person, but it is a 1099 dividend, which may offer some tax advantages as opposed to K1s or 1099 interest forms.
So would this be considered investment income, not earned income?
It would be considered a qualified dividend.
Okay.
Which is long-term capital gains, which is not ordinary income tax. However, I will defer to the tax professionals on this, on how it, you know, affects each person's unique situation.
Gotcha. Okay.
As far as experience of our firm, you know, we've managed over 600 fix and flips of notes. We've done business in over 40 states and have managed 5 prior offerings that have gone full cycle, meaning we've had funds that have gone from start to finish 5 times and met or exceeded the expectations of our investors. We also have a track record verification report to verify that for you. And then we do have a vertically integrated team, which I think is very important because it does 2 things. On the asset management side, it allows us to really move through the fix and flip process quickly because we're not waiting on an external asset management company to get back to us. We handle everything from acquisition to onboarding and selling the notes all in-house. And then same thing on our investor relations side, everything is done in-house. And then historically, we've never missed a distribution to our investors. However, little asterisk, past performance is not a guarantee of future results.
Mm-hmm.
And then I just wanted to throw this up there. If anyone is interested in kind of speaking with me, learning more, you can scan this QR code and it'll take you to my calendar where you can book a call with me.
Excellent. Excellent. Well, that's a lot of information and it sounds like a lot of work. I don't know if you've ever done a 501c3, nonprofit, ever tried to start something like that up. It sounds like what you're doing here as a business is even more involved than a nonprofit. There's a lot of different aspects to juggle and deal with.
Yeah, there's definitely a lot of, we'll say, nuance to it.
Yeah, which makes, whoever invests in it feel like, wow, there's nothing I have to do. This is pretty easy.
Yeah, it's definitely very passive, that's for sure.
Excellent. Wow, that sounds wonderful. Jeez. Good job.
Thanks.
Very good job. This is quite a thing to do. And I'm very very impressed with what you're up to here.
Thanks. Yeah, it's a team effort. We have a great team, and both on the investor relations and the asset management side, and my co-founder. So yeah, we kind of hit all the bases as a team.
Probably one question I'm just wondering that you may have covered and somehow I missed it. As you have the investment, and let's say values of the property goes up, how does that work into everything that you're doing?
The values of the property going up wouldn't really affect much as far as what it would affect is the acquisitions.
Okay.
So let's talk about COVID. We have very notoriously historically low interest rates, we should say, and we had property values that were soaring. So what that did on a buy side for us was it made it harder to find better deals because everyone was like, well, there's so much value in equity here. Even if this person hasn't paid, you can foreclose and you're sitting pretty. So It did make it a little bit harder to buy assets. But on the flip side, rates were so low that all of our assets were getting refinanced and we were getting payoffs so quickly. So it was like catch-22.
Catch-22. And then when the market's going down, how does that affect what you're doing?
Yeah, so we typically mortgage notes do well in a downturn market.
Okay.
Yeah, so right now we're seeing we track jobs and credit card debt. So we're seeing defaults on credit card, we're seeing job loss, we're thinking, okay, what comes next? People can't pay their mortgages. And then we see the defaults. And then about, I'd say 12 months down the line, we're going to see more and more inventory hit the market, which allows us to get better pricing. Interest rates are pretty, like I mentioned, we're pretty interest rate agnostic as far as when we bid, because when we bid, we take into account the interest rate on the anticipated yield we're trying to get. So we're not really tied to a specific interest rate environment.
Okay. And do you have a sense of your business being automated with all this AI coming out? Is there help there? Or is it kind of like double-edged sword?
I don't think there's really I think it can help. I know Microsoft, we use Microsoft, has some AI integrations, and we do have used ChatGPT for some things, from a content perspective. However, there's nothing that this is such a nuanced and very niche asset class that really it takes that experience. And every state is so different. So I could see it being helpful from a research perspective. Say we have a loan in a state we don't normally do a ton of business, being able to use ChatGPT to research the foreclosure law or the timeline, or, hey, spit out a list of 20 attorneys that do this specifically, it could be helpful there. But from actual running through the process, not so much.
Okay. And then for the side with the individuals who own the homes that are getting displaced by artificial intelligence, and my guess is there's a lot more properties out there for you to work with people who are kind of dealing with this whole situation of joblessness and as we move forward in that venue. You know what I'm saying?
Yeah, I mean, so a lot of people ask, how does this compare to 2008? Because when people hear mortgage notes, they think, oh my gosh, mortgage-backed securities, and it's, kind of PTSD for some people.
Right.
So I always like to talk about how it was very different. Like the lending environment was very different. Those were bad loans written to people who weren't qualified. Now we have loans written to people who are qualified that fell on hard times. You add to it that rental rates across the country have skyrocketed and there's no inventory. When we approach borrowers, they're highly incentivized to stay in their home and work with us.
Gotcha.
Because they're not going to want to, they have a 3-bedroom, 2-bath house. They're paying $5,000 for their mortgage a month. That 3-bedroom, 2-bath house as a rental probably would go for $8,000. And so you're, I'm talking California.
Right. Right.
So, so they're incentivized to continue to figure out a way to make it work because they can't afford to move somewhere else if they can even find somewhere else.
And they probably have a low interest rate from when that came out during the pandemic.
Yeah. Okay. And then not even if you take into account like the emotional equity they have, they might've been in that house for 20 years and then COVID hit and they lost their job. And, so a lot happens. And I think that borrowers are just incentivized to work with us more than they were in 2008 when they could just walk away.
Yeah. Yeah. That makes a lot of sense because they don't want to walk away. I think in this environment.
Yeah.
Where before they were upside down on the loan and there was just all kinds of problems.
Yeah.
Okay. Interesting. Very interesting. Fun stuff you're doing.
Thanks. Yeah, we enjoy it. Yeah, we enjoyed it. It's been a journey.
Well, excellent. I think you've got a lot of good services to offer people. So do you do anything with vacant land?
We don't. We're really specified, like specific to our niche, which is single family homes.
Single family homes. And is there a reason for that or something that I just don't see here?
No, I think it's just that's what we started with. And I think for us, focus on a specific market is key, especially when we work with a lot of financial advisors and RIAs and, to show that we're focused and we're not like chasing the next shiny object. I think it's really important for like stability of investors.
Would you say there's just a lot more people in homes than there is people owning vacant land and issues with vacant land?
Yeah, there's definitely more. I mean, the market is, like a $14 trillion market. I think you have like 200 to 500 billion in single family non-performing debt. Okay. So it's a massive market. Everyone needs a home. Everyone needs a place to live. So I think that it's just, it's kind of what we started out in, and just the opportunity is a lot larger than is land or commercial.
Gotcha. Even commercial. So commercial is kind of in the same class as land as far as how you see all this.
Yeah.
Interesting. Interesting. Wow. Fantastic. Good stuff. Yeah. I really, really do appreciate you taking the time and doing this. Santa Barbara is a small venue, and I think you do live here in Santa Barbara.
I do. Okay. Yeah.
So, before the pandemic, we had, good turnouts for meetings in Santa Barbara, meaning 25 to 30 people. I saw people come in here that would spend $6,000 or $7,000 in advertising, have a room with 100 people or 400 people, and only have 25 or 30 show up because Santa Barbara is a small venue. So what you're heading down to in Los Angeles for the Expo 5 is where that stuff can happen. And I'm so glad that you're doing that. And I'm so glad that you agreed to do this rather than try to do something here in town, because I just don't see something as small as Santa Barbara even recovering from the pandemic, because people were barely coming to a small town in the first place, where they're already down there in Los Angeles. If anybody's going to travel, they're going to go that way, not come this way,
No, even though it's way nicer here.
Yeah, well, that's one of the reasons that we ended up starting the Santa Barbara Real Estate Investor Association, is we just didn't want to go there. And, we wanted to bring these speakers like you here so that we can enjoy this. And I'm kind of, transitioning to the point where people got so used to during the pandemic to have, things like Zoom and the video chats that we're doing right now, and they're fine with that, and they don't have to travel, and it's just it's the information's there, whatever they want to go back and review it. There is something to be said about having
in-person
contact. There's a lot of value there, but I think you either have to choose to go from here to there or live there, and I think you've got the best of all worlds.
There you go. Yeah. So LA, that'll probably be one of the bigger crowds that I've spoken to, but
it will be guaranteed.
How big is it? I don't know. I mean, I've spoken to like a group of 500 financial advisors, which I feel like is a little more intense because they are very analytical.
Yeah. And I think you're good starting off, being in the beginning of the whole thing, because, people with all that going on have a tendency to get so tired after a certain amount of time that if you're starting off at the beginning, you should be like, in good shape. It'll be fun.
Love it. Love it.
Okay, well, thank you so much. I don't know, if there's anything you want to cover else. I think you've done a really, really good job, and we will get this posted up on the Santa Barbara REIA and also the YouTube site, and we'll continue to drive people back to you. And I think it's a wonderful thing that you're offering here. It really opens up the door for a lot of people.
Yeah, awesome. Well, I appreciate you having me. Happy to be here, and thanks so much.
Okay, thank you, Laura.
Thanks.
I really appreciate it, and thank you too, Tony, for all your help to arrange it all. And we got through it without the internet here dying.
Tony got us together. We just showed up.
So cool. Well, I wish you the best of what you're doing.
Awesome. Thanks, Dan.
Thanks, guys.
Have a good one.
Bye. You take care. Bye.